Hello, everyone. My name is the President, and welcome to Generational Blessings. I have a very special guest with me today, one of my good friends, Brandon Glover. And today we'll be talking about basic principles in regards to investing in the stock market. And I just have a disclaimer I'd like to read for everyone, which is please be aware there are risks involved with investing money. Therefore, discuss investments with a financial advisor and get all the pertinent information you need before you make any investments. The information given in this video is not to be construed as financial advice, to be taken in place of advice from a financial advisor. So just to introduce Mr. Glover here, he is an independent investment fund manager. He has developed and implemented trading strategies involving financial derivatives and contracts on the S&P 500. So yes, Mr. Glover.
Hey, how you doing, man? Thanks for
Hey.
the intro. Much appreciated. Yeah, happy to get started.
Yes, thank you for joining the show here. Very happy to have you here.
Yeah, right on.
Yeah. Okay. So we'll go ahead and get into it. So the first question is, what are basic principles someone should understand before investing in the stock market?
Right. So you want to think first, like, what is the stock market, right? It's this collection of companies that have all, offered pieces of their company up to the public in order to raise capital, help with their operations and everything like that, right? But when you look at the market in total, what you really want to understand is something very crucial, which is that there's a very short-term and long-term dynamic at play. In the short term, the stock market is a voting machine. It votes on what it thinks is hot, what it thinks will make money like now. That is much more likely to include a lot of, let's say, retail, smaller investors, people like me, right? Me and you, right? People with, smaller bank accounts, certainly than like an investment bank or hedge funds or any of those large financial players, right? So in the short term, it votes on the stocks it likes. In the long term, the stock market is a weighing machine, and that's where value is truly determined, right? So if you want to look at like a company such as like Berkshire Hathaway, right, and forget about their own stock listing, which they have their Class A shares are like six figures, they're a couple $100,000, right? And that's to protect value and protect who has a foray into their board and voting rights and all that kind of stuff, right? But in any case, if you look at what they've invested in not a lot of companies. Their list is not that long. I want to say there's a dozen or 15 stocks on their list. And if you really look over time, these are companies that have overcome regulatory risk. These are companies that just have long-standing, strong businesses with other businesses and the American consumer and the global consumer at large. So, the basic principles you need to understand are what creates value. You understand what value is and how it's created. And value is always being created in the long term. That popularity that we talked about, that voting machine aspect of the stock market, that's short term. You have plenty of stocks that balloon to crazy market caps for a short period of time, right? You have tons of examples of a $1 billion company that became worth 50 billion, but then 3 years later, it was worth 1 billion again, or maybe even less. These examples are all over markets. So you want to understand again, what is value creation, what companies and what financial instruments are the arbiters and the creators of that value versus the short term, what is hot.
That's a good way to put it. I was reading Warren Buffett's book, and he was talking about how with the stock market, you have to invest in it over time to make money. And it just feels like sometimes some people think that, hey, I can get lucky, maybe invest in Apple, and then all of a sudden, in a year or two, my investment of, I don't know, $100 is going to be worth 10,000 or whatever. But usually it just takes time, and you're not always going to get that home run is what I'm trying to say. So I like how
Yeah.
you explain that with the value.
Yeah. You don't care about hitting home runs. It's all singles and doubles. You're going to hit a lot of singles and doubles, and you're going to need more of them than you would need of home runs, but they're definitely the safer plays. They're, there's a saying in time in the markets beats timing the markets. So those big swings that you're talking about, you have to have impeccable timing. But you're never going to buy the bottom of a market. You're never going to sell the top of a market. You need to have that in place, because if you think you are going to buy the bottom or sell the top of a market, you basically are searching for perfection. And that doesn't exist. We all know human beings, we're imperfect. We all know this. So you can't time a market perfectly. A market and the price of a security, the price that the market places on something, that represents all available knowledge that the market has on that security, right? So how could you possibly as an individual know that?
No,
You know,
that.
there's not, it's
Yeah.
not possible. It's just
Yeah.
not possible. So you may make sure to, be realistic, absolutely be realistic. You have to understand that, like, if you're just beating inflation, like
You're doing good.
congratulations, like you're beating
Yeah.
inflation, like start there, like just beat inflation. You need to be trying to make 3, 5, 8% a year. Like these are the small, like smaller numbers, like even 8% a year. Like if you had a hedge fund that was doing 8% a year, like that would, they're not, that's not, those are not spectacular returns, but like that is something, the compound annualized growth rate on something like that is, you're going to get 100% in what 10 years on something like that, maybe even less, at 8% a year. So anyway, to do away with the math, you just want to be realistic, like you said, your Apple example. Oh, my $100 is going to become $10,000. Do you recognize that that is a 100x in the enterprise value of Apple? Apple's already worth like $3 trillion. Like, so you're saying it's going to be worth 300 trillion? Like, nah, this is not, it's not going to happen. So you definitely want to be realistic, keep the numbers in front of you, and, don't be afraid of small returns, because you want to inch forward. You don't want to make these great leaps forward, because that's what creates larger risk propositions. Now, there are ways to go about that, right? Like when you talk about stock investing versus options versus Forex and all these other vehicles, right? There are ways to start making those leaps forward, but generally speaking, people are going to want to take it low and slow, and take your time with it and start early.
So I love that. So basically, just to kind of sum it up, so get like a Ichiro single, because all this man did was just get singles instead of Barry Bonds home runs. You know what I
I
mean?
mean,
So
I mean,
just
yeah,
one time. Yeah.
singles and doubles, definitely. Those
Mhm.
move the men around the bases too. You're gonna score the runs with those too. So
Great
yeah,
way to
and it's
put it.
safer. So go
Yeah.
that way.
Okay. So for the next question, how should one evaluate a company's potential for growth when considering an investment?
Yeah, so great question. You definitely want to, first of all, does the market consider it a growth company, a growth stock? Because generally speaking, those are going to be the companies, like a stronger growth stock. Those are going to be the companies that are going to have an easier time acquiring capital, like borrowing from banks and, really getting what they need to move things down the line. A lot of growth is going to be concentrated into the tech sector, right? So when you look at like if you were to go on CNBC, pull up a ticker and look at some of the basic fundamental stats that they give you, one of the stats is called beta. Now, beta basically means the higher the beta, the more a stock is expected to outperform in a growth cycle, right? So if you were to look at certain tech companies, you're going to see betas of like 2 and 3 and up, right? Um, but if you were to look at, let's say, a company like a railroad, or utility, or like a power provider or something like that, when you look at their betas are going to be like 0.6, 0.8. They're going to be below 1, because they're expected to stay more stable in the in market fluctuate in when the market fluctuates, I should say. So when you're looking at growth, definitely look at a stock's beta first. Not first, but does the market consider it a growth prospect? Check that out. Then you want to look at, like, what's the product market fit? Are these products that are likely to continue to stay popular, or services that are continue to stay popular? So for example, it's notoriously difficult to make money in the restaurant business,
Mm.
right? But not if you're an investor. If you're an investor, it's not, I'm not saying it's easy to make money in the restaurant business, but you might have a better time of it than if you went to go open a restaurant, because everybody has to eat. Everybody likes gathering around a table at some interval with people that they care about, grabbing a meal, grabbing a drink. and and talking with their folks, so that's something that's just never really going to go away. So in that aspect, restaurants are like very, they're not very growth heavy, but they're stable, right? So you want to kind of be able to classify different companies in these ways, right? If you look at like an Apple or a Facebook, they're not. They're potentially growth companies, but they've already done so much growing that the growth prospects might be lagging. But then you look at a company like, they're not public yet, but if you were to look at a company like OpenAI, if OpenAI can kind of navigate their issues because they basically started as a nonprofit, but now they have for-profit elements, so it's causing some issues. Anyway, they're not public yet. But if they were to go public, that would be a growth prospect because we see what AI and language learning models and basically the search for AGI, artificial general intelligence. This is a growth area, right? So these are things you want to be looking at. And then another thing you want to look at are what are broader trends that may intersect with the business, right? So like we just talked about with AI, that's a broader trend. If you were to see one day populations starting to spike, right? Maybe you're looking more into entertainment, into the music industry. Maybe you're starting to look at things where the more people you can get involved, the larger the total addressable market. And then maybe things that haven't been considered growth prospects in the past would be considered growth prospects. So you definitely want to, and you want to just look to see, I would say lastly, the last thing you want to see is the company well run? When they put out a 10Q, saying what they are going to do over the quarter and how their business ran for the previous quarter. Did they do what they say what they said they were going to do? How was their corporate governance? What's the upheaval like? Is there board turnover? And this requires some study, and you really want to, if you're starting to hone in on individual names. But yeah, that's corporate governance is definitely a big part of this as well.
Wow, that was wonderful how you explained that. And so, based on what you were saying about doing some study, it really makes sense for the average person to get an advisor because we don't have time. The average person is working. I mean, they have kids, they're going to soccer practice, they're doing all this stuff, and you don't have time to really dig deep into a company and really understand the market to that level. I mean, and so it really makes sense to have someone who's just, that's their only job, just doing that. So that really, how you explain that just really emphasized the importance of an average person isn't just going to invest in the stock market and just become a Warren Buffett tomorrow. So
No, I mean, there's only one Warren Buffett.
Warren
You know what I
Buffett,
mean?
yeah,
There's several billion of us out here, right? So, that's not necessarily your goal, but one of your main goals is to embody as many of those principles as possible. So, like one thing Warren Buffett always talks about is um be be greedy when others are fearful and vice versa, fearful when others are greedy, right? You need to be buying when others are selling and selling when others are buying, right? So you want to do it over a long period of time and let compound interest work for you, let dividends work for you. I know we're going to discuss that shortly here, but use these vehicles and make them work for you. So yeah, becoming Warren Buffett, like you're not going to become Warren Buffett. I'm not going to become Warren. It's just not going to happen, right? So anybody listening to this, watching this, you're not. I'm sorry to burst your bubble, but you're never going to become Warren Buffett. But you could definitely like utilize a ton of principles that someone like him has taught the markets in general about how this whole thing works. Um, and what I was going to say also is going back to, if when you engage with a financial advisor, you do want to educate yourself to a point, right? You want to be able to use the most of your time. And then, and the internet has unlocked, obviously so many resources and so many ways to learn about these things. You want to be very careful, about what you listen to and what you take in. Anything that we say on this show, you should be going out and checking out for yourself and seeing if you agree or disagree. But yeah, on the point of a financial advisor, definitely a great idea. But like bring something to the table with them and really make the most of your time and your energies there.
yeah, very good point. Very good point on that one. Yeah. So next question, what role does dividends play in building generational wealth? And should they be reinvested?
Yeah, so absolutely. But dividends are, dividends are interesting, right? Because basically what the company is saying is that, hey, um, we understand that there may be larger growth prospects for you to look at out there, right? Who doesn't want the promise of 20% a year versus 10% a year versus 5% a year, right? Like that's just natural, right? People are going to gravitate towards what is going to grow faster. So with dividend stocks, what those companies say is like, hey, we understand this, but we have enough excess cash to pay you to hold this stock while you own it, right? So not only do you own the stock itself, you are generating cash flow from owning an asset, right? That's what real estate seeks to do. That's what you're trying to do with a lot of your assets in life. You're trying to generate cash flow with those assets, right? So a dividend stock is can be a really attractive option because as you collect those dividends and then reinvest them, you can just continue to own larger and larger portions of really strong companies. And you can really start to grow your wealth that way. It takes time, but it's a form of compound interest that can really help you out. Not only that, but I'm no tax professional at all, but I know the longer you hold a stock, the better it is. Like when you hold stocks longer than a year, that you're subject to maximum like 10% capital gains tax. If it's less than a year, I think it's 35. So that's a big difference. And
Yes.
then so that promotes a low and slow kind of a return also. And then now, the thing with dividends that I found is that you definitely want to be careful when you're picking companies based on their dividend yield. Okay. So if you were to look at certain companies, their dividend yield is really high. It could be like 8%, 9%, something like pretty high number. But then you have like really solid companies where their dividend is like 3%, 4%. And you might look and say, well, I'm just going to go with the company that has the higher dividend. That's not necessarily what you want to do because the reason why the larger, more stable company can offer a lower dividend yield is because they are more confident and the market is more confident that they can preserve their value over time, right? If a company offers a dividend that was established 10 years ago and has had wild fluctuations in their stock price, because that's the thing too, you're exposed on that end. Let's say that I offer an 8% dividend on a company and you buy the stock at $20, right? Well, let's say the stock gets cut in half and now it's $10. Well, basically, you're getting the same dividend as somebody that had a $20 stock the whole time at a 4% dividend yield. You see what I'm saying?
Yeah.
So
Yeah.
you want to definitely pick companies that are able to preserve and slowly grow their value over time rather than companies that have more riskier propositions. Let's say they have to offer higher dividend yields because that's how it becomes more attractive than some of those lower dividend yield offering stocks. But there's more danger in that, and you got to think more cash comes out of the business if they're offering a larger dividend yield as well. So then that may hurt their ability to grow and run their business. So you just got to be careful with all that stuff and do your due diligence and talk to a professional for sure.
Wow. Great explanation there. I think you really did well explaining everything and what that means. And I think one dividend stock that I looked at before, I think it was Coca-Cola. They
That's like
have,
number one dividend
yeah.
stock. Yeah.
Mhm. Yeah, so just wanted to throw that one out there. If people want to look at that, I'm not saying buy it, but just throwing that out there.
No, I mean, but so that's kind of what we're talking about, right? So like big, huge company, massive brand, probably one of the most iconic brands in the world by far. Their ability to preserve the value around their business is going to be high, right?
Mhm.
Like because even if let's say Coca-Cola misses a step, and sales slip or whatever, it's still the brand. Like they have all these connections with all these other companies, like quick service restaurants that only do Coca-Cola products and so on and so forth, right? So their ability to protect their value is really high. So yeah.
Yeah, great. Yeah. So next question, how important is diversification in a portfolio and how should it be approached?
Yeah, so there's a there's a saying
Mhm.
in markets that there is no free lunch in markets except for diversification. Now, let's say you had a pool of money, right? And you decide I'm going to do an equal split. I'm going to put a portion of the money in stocks, bonds, mutual funds, um, cryptocurrency, commodities, real estate, so on and so forth, right? So you identify, a number of sectors that you would deploy your capital in, right? If you were to come back 10 or 20 years later, the chances that you lost money are close to zero, assuming that you did the due diligence as you did your investments across those sectors, right? So, and that can be as simple as, buying an index fund that covers these different market segments, right? So, however you decide to do it, if you did it the smart way, you're not going to, over 10 or 20 years, you're not going to lose money, right? So, and that's what diversification offers you. Free cash flow. Cash is it's interesting. You think about in a broader sense, you need to think about cash
Mhm.
as blood that circulates through the body that is the economy, right? That blood has to go somewhere. Like it's not just going to stay in the veins. It's going to move through those veins, be in arteries via being cash, being liquid, but it's going to go somewhere. It's going to the heart. It's going to the brain. It's going to your extremities. It's going to your liver. It's going everywhere, right? So that's how cash operates in society. Like it has to land somewhere. And institutional players and retail investors, they may hoard more cash than usual at some spots, but generally speaking, cash is just going to be somewhere. So if you put your cash into different market segments, like we were just talking about, stocks, bonds, like whatever, like just flush them all out, real estate, whatever. Like I said, you're going to be in the flow of what's in vogue at some point, right? So losses in one area will be covered by gains in another. Now, you're not going to make outsized gains with something like that, but it's a base layer of protection that you definitely want to employ in some fashion. So a lot of what portfolio managers and hedge funds used to talk about, it's a dynamic that seems to be breaking down lately, but they used to talk about a barbell strategy. And that barbell being you want to be between 50 and 60% equities, stocks, and you want to be between 40 and 50% bonds. Now, the way treasuries have behaved over the past, let's say 15 years makes that kind of a stranger dynamic than it used to be. But because bonds used to yield higher. Now bonds are not as attractive as they used to be because the interest rates just generally are lower. But in a general sense, the reason why they said that is because, okay, the money's going to flow between one of these two sides, right? So you're going to be capturing value, whether they're in equities and then equities are in a bull market, or the market is scared and bonds start to become in a bull market and rates get driven down, you're going to be making money somewhere, right? So yeah, to definitely want to diversify, shouldn't, putting all your eggs in one basket. There may be times, very select times where you're going that direction, but generally speaking, you're not. Generally speaking, collect your eggs, make a few baskets, decide like for instance, and not every basket, you may not put much importance on a basket, right? So like maybe you don't believe in cryptocurrency. Like maybe you're just like, I don't believe in it, I don't understand it, I'm just going to stay away. That's perfectly reasonable. That might not be the best decision, but it's a reasonable decision. And again, something you should talk about with a financial advisor, things like that. But yeah, absolutely diversification is a necessary part of a successful investment plan.
Yes, I think you really explained that really well, because I always think of it as like what you said, not putting all your eggs in one basket because if that basket breaks, oh, there's all your eggs. You ain't got
Yeah, I
any
mean,
left.
yeah,
So,
that's just the truth of the matter. Like for instance,
mhm,
if you were totally exposed to just equities, like in 2008, let's say, right? I mean, in 2008, from January to November, the market basically sold off 50% in a straight line. So if you weren't, agile and you weren't able to start piling, taking your gains in the stocks, by November, by the time Barack Obama was elected, you're just looking at a portfolio that's been cut in half. And, in the face of inflation, which is a constant, inflation is only ever just high or low. It's never absent, right? So that's a lot of capital. And that's something that could really, harm your ability to reinvest and to grow your wealth over time and, set yourself up for that day when you either don't want to or can't work or whatever, right? Everybody wants to be set up for that.
exactly. Yeah. Okay, so I'll go into the final question here. What are some common mistakes that new investors make, and how can they be avoided?
Yeah. So first, I would say the most common mistake is impatience. right? You see something, you're like, hey, I want to jump on this, and then you wind up buying the top of a market, and then you're in a bad spot, right? Because all you're doing is watching it go down over time, and then you're not sure, should I reinvest? Should I reinvest more? Should I sell? Like you just get stuck in a bad spot, right? So let a market start to play out, and really start to make your decisions from there. I would say the next mistake is leverage. You want to use your own capital. Use your money. Don't use anyone else's money. And I say this from personal experience. Like you will be able to make the best decisions you can in a free sense, in a clear-headed sense, when you know it's just your money. Like that. So don't over leverage. Don't get it like margin is something that's very tempting to get into to that relationship with banks, but it's just generally something I would not advise. And then the last thing I would say is the most common mistake that investors make is they make a little bit of money
Mhm.
and they sell. They're like, hey, I just captured 10%, boom, I'm out. I just made a dime out of a dollar, right? So and they sell their winners. And then what happens with their losers is the hope starts to creep in. They're like, I think it'll turn around. I think I could do better. Maybe I could just dollar cost average and keep buying, to bring down my midpoint, bring down my dollar cost. And generally that's just a mistake. You should be doing exactly the opposite. When the trade's going against you, just sell, just get out of it. If it's something that is on a trade level. Now we're talking mostly about investing. Now you may have made a bad investment, right? Like if you get into an investment and sells off 20%, like in a couple of months, you probably made a mistake. You should probably just sell, right? Um, Now do the opposite, right? Now with winners, you do the opposite. Let them run, let them go. Like the market is taking them on an upward trajectory. Let that happen. Generally speaking, I'm not saying you try to ride it all the way till the end, but generally speaking, people are cutting winners short and they're letting losers run. They need to do exact opposite.
Mm, yeah, great advice. And so basically to sum all this up, how does everything that you mentioned come into play for generational wealth and creating that for your family members down the line, for their kids, and so on and so forth?
Yeah, so like it's really just understanding of purpose and what you're trying to do, right? Like what everybody's doing, like life is a great gulf. It's a great gulf of water that we need to like successfully traverse, right? So what we're trying to do with investing in capital and acquiring assets is we're trying to place stones in that water in front of us that we can step on so that we can place the next stone and step on that, and then eventually we get to that other side, financial independence, the ability to retire, however you want to define that, right? So you know that's why taking it low and slow, starting early, super duper important. And then and just being diligent, just being diligent about it and understanding that if you take the right tack and take the right approach, there's really no limits to it except your own time and energy and ability to apply what you know to the markets. But it's a very, there's a reason why finance has grown into the industrial giant of basically the world and for sure America. Like if you say what is America's industry, it's finance, right?
Mm.
So at a minimum, you need to know how to speak the language and be able to get around. You don't have to become some titan of industry, and don't put that pressure on yourself to begin with anyway, because then you're going to overshoot. You're going to overshoot. You're going to overstep. You're going to take risks that you don't need to take, and yeah, you want to just take your time with it, but do it for the like again for the future. You have to understand too that you're doing this for the future. You have to be careful with it, because if you take away that future step, you might take two steps back before you can even take one more step forward, right? So you just want to take your time with it and be careful.
Yes, I really like how you said about understanding your goals and what you're trying to get from it. And a way how I look at it is that I have a account at a bank and I'm only getting like 0.5% interest. Like I'm
Mhm.
not getting that much on a savings account.
Right, right,
And how you really gain money is investing it. Because if you just leave your money in a bank account, you're barely going to get any interest on it. And so, and
mhm,
most people aren't going to have like 5, $10 million to put in the bank anyway. And
right,
plus FDIC is only up to 2000, I'm sorry, 20, 250,000.
250
And
there.
so,
Mhm.
yeah, so it's not
Yeah.
insured past that. But anyway, digress
Yeah.
a little bit. My point is, you're not really going to gain money from just putting your money in a traditional savings account in the bank.
No, you're not. Definitely, the interest rate environment, like you mentioned, has just changed way too much. When I was a kid, I think interest rates were like somewhere around 8%. So if I left $100 in a bank account for a year, I could expect $8 out of it. Like that's for a kid that doesn't need money, that's like got $100, like that's fine, right? But I mean, when you're talking about the return now on that $100 is, yeah, like you said, 50 cents, not $8. Like
Mhm.
you're not even coming close to outpacing inflation. And yeah,
Inflation, that's it right there.
inflation is the key, and that's
That's the
why
key.
too I would encourage people to just start learning about the economy from a macro level. You need to understand the Federal Reserve, you need to understand interest rates, you need to understand inflation, you need to understand commodities, the financial sector, like and just a little bit of understanding on all of these things is going to really help like raise your floor as far as your ability to apply these concepts and really wander your way through because or for instance, right, or even learning about all your options. For instance, I don't know what kind of high yield savings accounts might be available for you, but you have high yield savings accounts that might be offering 4%, 4.5%, 5%. So look at those kinds of options instead of like traditional savings account, because a traditional savings account, the bank is making money off of you for sure, right? So whereas you want to try to flip that relationship as much as you can. So yeah, learning about all your different options, and like I said, just learning about how the economy works in a general sense will raise your floor. That's really important, I think.
Yes, and like how you said with those other savings accounts, you can get the high yield savings accounts in the bank.
Mhm.
The stock market is still going to beat those high yield savings accounts, aren't they?
Year over year, yeah, not every single year. Obviously, like I said, 2008, the market sold off 50% in a straight line. It was just a diagonal to the right line. It was crazy. But you know, most years, just if you were to look at large periods of time, absolutely the market outperforms for sure. So like index funds investing passively in the S&P or even the Nasdaq, which is, got the tech sector, so growth introduces a different proposition here. But just generally speaking, yeah, if you want to get exposure via index funds or anything like that, generally speaking, yes, you're going to massively outpace what you can make from a traditional bank account. And those outsized years, you can trim, you can harvest the cash, in the high performing years, and then as you diversify your portfolio, that's you start to turn those returns into investable opportunities and maybe market segments that have been downtrodden a little bit but are long term stable.
Great. Yes. So I really enjoyed this conversation, very informative. You really answered all the questions well, gave some great knowledge for the audience. And I'm thinking maybe could even do a part two on this, considering. And so I wanted to thank
Anytime.
you for being a guest on the show and any final thoughts that you'd like to share.
Yeah, just want to say first, thanks for having me on. We'll love to do it again, and I really good luck with your mission. Turning those generational curses into generational blessings for our community and just for people in general. It doesn't just have to be for people that look like us, right? Like anybody can learn from this, and yeah, just really believe in the mission and wish you best of luck in all your efforts here.
Thank you. Yes. And I just want to say, but basically, my whole purpose of doing this one episode was like how you said, for people to understand the economy because it impacts our lives so much,
Mhm.
and it's hard to think about investments when you're in survival mode. And so I
Yeah.
want to get that information out there that there's an alternative beyond just what we've seen with traditional banking and
Mhm.
how to grow money over time for your family and for that next generation. And so you did a great job of summing all that up, and we look forward to having the audience come back for our next episode. So thank you very much.
All right, sounds good, man. Thank you
Okay.
so much.
All right. Okay.